Welcome back. Previous breakdowns examined the brutal mathematical reality of the Canadian economy. Earning a six-figure salary, even up to $250,000 a year, is no longer a guarantee of financial freedom. The golden cage has been exposed. The Canada Revenue Agency, the CRA, and the relentless cost of living in cities like Toronto and Vancouver systematically devour income. Relying purely on a paycheck to build wealth in Canada is a game mathematically rigged against the earner. The system is designed to tax labor at the highest possible rate. But today, the focus shifts to building. The solution isn't necessarily working 80 hours a week to earn more money, because the CRA will simply take half of the increase anyway. The real solution is keeping the capital already earned. It requires building a financial bunker. What exactly is a financial bunker? It is a digital, legally protected fortress where the standard, crushing rules of the Canadian tax system simply do not apply. Outside the bunker, every dollar earned is exposed. Inside the bunker, money is shielded. Today opens the tactical manual on how to legally shield wealth using the two most powerful weapons in the Canadian financial arsenal, the TFSA and the FHSA. The cornerstone of this defense is the tax-free savings account, or TFSA. The biggest myth in Canadian personal finance must be destroyed right now. The TFSA is not a savings account. That name is the biggest marketing failure in government history. Calling it a savings account is like calling a military jet a golf cart. It is a tragedy how often this account is used just to hold cash at a traditional bank, earning a pathetic 2% interest that doesn't even beat inflation. A TFSA is an investment vessel. It is an empty basket ready to be filled with chosen investments. The smart move is never to hold cash. This bunker is used to hold appreciating assets, stocks, index funds, exchange-traded funds, and dividend-paying companies. The magic of this account lies in those two beautiful words, tax-free. It means exactly what it says. Every single dollar invested inside this bunker, and every single dollar that investment generates through dividends or massive capital gains, is 100% invisible to the CRA. When funds are withdrawn, whether at age 50, 70, or next Tuesday, all of it is kept. Not a single cent of capital gains tax is paid. To truly understand the power of this shield, the math of compound interest must be examined. In a normal, unregistered investing account, growth is constantly interrupted by taxes. Imagine an investment generates a $10,000 profit. In a normal account, the CRA steps in and takes a significant cut of those gains. Less money is left over to reinvest, which dramatically slows down compounding momentum year after year. It is a massive drag on wealth. But inside the TFSA bunker, compounding happens at hyperspeed in an absolute vacuum. The money grows, the dividends are paid out, and the principal expands, completely uninterrupted by taxes. Look at a timeline. Maximizing TFSA contributions and investing in a broad market index fund, returning an average of 8% a year over a 25 or 30-year horizon, creates hundreds of thousands of dollars in extra wealth compared to a taxable account. It is the difference between retiring comfortably and working until age 70. It is the closest thing to legal magic in the Canadian tax code, and money is lost every day it isn't used properly. Even the strongest bunker has strict security protocols. The government provides the shield, but sets strict limits. The absolute first rule is the contribution limit. The CRA dictates exactly how much new cash can be put into the bunker each year. For 2024, the annual limit is $7,000. However, contribution room accumulates starting from the year an individual turns 18. If no contributions have ever been made, and the individual was 18 before 2009, the total lifetime limit is $95,000. Over-contributing is a fatal error. If the allowed limit is exceeded, the CRA issues a strict 1% penalty per month on the excess amount. This brings up the TFSA's second secret weapon: absolute flexibility. Unlike the RRSP, which locks money down until retirement and taxes withdrawals, TFSA funds can be withdrawn at any time, for any reason, with zero tax penalties. But here is the critical part that is usually missed. When money is withdrawn from a TFSA, that exact contribution room is returned on January 1st of the following calendar year. If $20,000 is taken out today for an emergency, next year the contribution limit increases by the standard annual amount, plus that $20,000. It is a fully renewable shield. Next is the newest, most specialized weapon in the arsenal: the First Home Savings Account, or FHSA. This account was created specifically to target the biggest financial nightmare in Canada: housing affordability. The FHSA is a hybrid account. It takes the absolute best features of the TFSA and the RRSP and merges them into a specialized anti-tax missile. It is designed for one specific mission: buying a first qualifying home in Canada. The legendary double benefit makes the FHSA incredibly powerful. Contributions to the FHSA are tax-deductible, just like an RRSP, and withdrawals are completely tax-free, just like a TFSA, as long as the money is used to buy a home. Contributions can reach up to $8,000 per year, with a lifetime limit of $40,000. Making that $8,000 contribution lowers taxable income by exactly $8,000. If an earner makes $100,000 a year, the CRA now taxes that income as if it were only $92,000. For a high earner, this triggers a massive tax refund at the end of the year. That $2,000 or $3,000 refund from the government can then be immediately reinvested back into a TFSA. It is the ultimate financial double dip. The optimal deployment strategy for the TFSA and FHSA depends entirely on the end goal. If purchasing real estate within the next decade is the priority, maxing the FHSA is paramount due to the immediate tax deduction. That benefit is simply too powerful to ignore. Once the $8,000 annual FHSA limit is reached, surplus capital should flow directly to the TFSA for uninterrupted, tax-free compounding. Together, they form a synergistic front-end and back-end defense system. However, precision handling is required. The FHSA has a mandatory 15-year limit. Funds must be used for a qualifying home purchase within that window, transferred to an RRSP, or be fully taxed as income if taken as cash, destroying the entire benefit. Compliance is essential. Security is built by using math and the legal tax code to systematically protect capital. The Canadian economy's salary trap is not a mandatory destiny. Learn the rules, utilize the accounts, and build the bunker. Shields up. Subscribe to join the community, run the numbers, and start compounding. However, precision handling is required. The FHSA has a mandatory 15-year limit. Funds must be used for a qualifying home purchase within that window, transferred to an RRSP, or be fully taxed as income if taken as cash, destroying the entire benefit. Compliance is essential. Security is built by using math and the legal tax code to systematically protect capital. The Canadian economy's salary trap is not a mandatory destiny. Learn the rules, utilize the accounts, and build the bunker. Shields up. Subscribe to join the community, run the numbers, and start compounding.